Hello everyone, so I'm going to do a video about the time value of money and also bond pricing. The two concepts are very closely related. You can't actually calculate the price of a bond without introducing the time value of money. So we talked in previous videos about what a bond is. It's basically a way for a company or an organization to raise money by issuing a bond and thereby borrowing money from investors, and then an obligation on the back of that to pay a percentage of the amount borrowed, over well-defined periods of time, and then a commitment to pay the full amount back at the end of the lifetime of the bond. And we also talked about the fact that during an actual typical life cycle of these bonds, it might be, say, a 10-year bond. So Rolls-Royce might borrow money for 10 years and issue a bond that has a 10-year maturity. But the initial investors who buy that bond won't necessarily hold that bond for the full 10 years until the bond matures. Often what will happen, as we saw in the previous video, is that dealers, like the sell side dealer desks at the investment banks, will facilitate buying and selling of these bonds on the secondary market between different investors. So obviously that raises the key question. Well, how do we determine, or how do the investors determine what is the fair price to pay for a bond, right? So if you think about, okay, well, what am I buying when I buy a bond of someone else that's in the secondary market? What you're effectively doing is you are buying the entitlement to receive from that point onwards the coupon payments, and also, as long as you hold it until the end of the maturity, all the money back. Okay, so you can start to get an idea of the kinds of the asset that you're buying is the entitlement to receive these cash flows. The question is, how much is that entitlement worth now? Because I'm going to buy the bond now, and it actually involves physically, well, not physically, but it actually involves handing over an amount of money today that's going to be taken out of my bank account and credited into someone else's bank account, right? So that amount has to be decided. So this video is going to be about kind of how we calculate what that amount should be. And then also, so as I mentioned, so we're going to talk about two main areas here. First of all, we're going to talk about present value, because ultimately the price of a bond is determined by what's called the present value of all the cash flows that it's going to pay out. And then we'll go on to the sort of the more general formula for the price of a bond based on the amount of principal, so M, and the coupon it pays, right? So we're going to go into these two formulas. Hopefully it's going to be fairly clear. Again, probably not going to be the shortest video, but I hope it will at least be detailed and clear. Okay, so let's get started. So I've got my lecture notes over here, lecture notes, whatever you want to call it, just to basically guide me. And there's a lot of cool links that I've found, and I will make sure that I link all the materials that I use in each video down below so you can see it too. So in a nutshell, basically the time value of money is centered on the concept that if somebody says, I'm going to pay you £1,000, right? But I'm going to pay you. You can choose between either having it today or in 3 years' time, right? I'm going to try and keep this brief because it's fairly obvious. So clearly, anybody in their right mind is going to say, "Yeah, I'll have it today, please." Lots of intuitive reasons why that might happen. Inflation, assuming it's positive, means that £1,000 is going to have less spending power in 3 years' time. The main reason actually is that you can do other things with that with that £1,000 over the next 3 years. So by having it in your hands today, such that in that 3 year time frame, it will actually be worth more than £1,000, right? So therefore, you'll be better off than if you waited to receive it in 3 years. And the simplest way to model how that £1,000 might grow in 3 years is to say, well, let's take that £1,000 and just pop it in a nice risk-free, supposedly, bank account, right? And let's say the bank, this bank account is paying 10% interest per year, right? So as we know, and this really goes back to the compound interest concept that we talked about in the early video. I'm not going to go over it in too much detail again, I hope. But really, what that means is that after year one, right, your initial investment is now worth £1,000 times 1 plus 0.1, right, which is £1,100. Okay, and then assuming that you keep the money, including the interest, in the bank account for the second year, and the interest rate doesn't change, then after year two, it is now worth, so this amount here times the same value again, which equals 1,210. And then after year three, which is the time period after which we were offered the choice to receive the £10 alternatively, but if we took it today and after 3 years we invest it, then the total amount that we have is basically £1,000 times 1.1 to the power 3, which equals £1,331, right? So the key concept here, and this is really enough to illustrate the concept, is that by taking the £1,000 up front today and then investing it in my chosen alternative investment strategy, probably a bank account being the most obvious risk-free one, I've actually managed to earn myself a tidy profit of £331, right? So I'm £331 better off by taking that money up front and investing it in a bank account for those 3 years, rather than waiting for it for 3 years. And in a nutshell, that is the time value of money. So just to recap, let's just formalize this into the formula again. We have so in this case, we have the future value, which was £1,331, is equal to the present value, as in the amount today, which is £1,000. That's the amount of money that I'm being offered today, multiplied by 1 plus I to the power n, where I was our interest rate, which was 10% or 0.1, and n is the number of years, or the number of periods over which I applies. So if I is an annual interest rate, then the n represents the number of years. If I is expressed as a periodic, like a quarterly interest rate, then n is the number of quarters, right? But ultimately, it's the number of times that you're multiplying by that factor. Okay, so n was the number 3, right? So just plug in some numbers there. But what we see is, so the future value of our investment equals, this is just the compound interest formula, the present value multiplied by 1 plus the interest rate to the power n. And you can just, that's exactly what we've done up here, right? Now, the present value of money is literally just taking that equation, this one here, and turning it upside down a little bit and saying, well, okay, what is my present value as a function of future value, interest rate, and number of years, right? So very simple rearrangement gives you present value is future value over 1 plus I to the power n, right? Just rearranging the above. And again, plugging exactly the same numbers in, you can ask yourself the question, so present value was 1,000, right? Future value was 1,331. So the question here can be rephrased as, if someone offers me £1,331, okay, in 3 years from now, what is that worth today, right? If, and here's the key assumption, if my investment rate, my available earning capacity, the interest rate which I can use that upfront amount for is 10%, right? So if effectively it's like my opportunity cost of not having the money today, right? Because any money I do have today, I'm saying I can tie up in this 10% and make 10% a year, right? So if my interest rate equals 10%, right? So you've got those numbers there, and the answer, rearranging the above equation as we've done, is that PV is £1,000, right? So just to recap, I know I'm hammering it home a little bit, but the key concept here is that if my available interest rate that I can tie up money today and earn interest on is 10%, then somebody offering me, promising me to pay me £1,331 3 years from now gives me exactly the same implication of my kind of total return, my wealth in 3 years' time, as if they give me £1,000 in my pocket today, because then I take that £1,000 and I'm going to drop it in the bank account and earn 10% over 3 years and end up with £1,331. Okay, so that in a nutshell is present value. Now, there's a really good article which I'll link down below over here about discount factors and the time value of money. So basically, just in terms of the naming conventions, right? So in this formula that I've written here, right? So this is called the present value, right? And then FV is the future value, and then this term here, 1 over 1 plus I to the n, which we're basically multiplying by future value, is called the discount factor, right? Very important. You hear this all over the place. Excuse me. and I is what's called your discount rate, right? So that's some of the key terms. So what does this have to do with pricing of a bond, right? So we've kind of covered the present value, right? So the formula for present value, we said PV is future value divided by 1 plus I to the n, right? Where I is your alternative savings rate or your discount rate, and n is the number of periods, right, over which you're discounting, right? So what's this got to do with the price of a bond? Well, so as I said in the introduction, right, if you think about what you're buying when you buy a bond is the entitlement to receive cash flows over time as follows, right? So let's say, this is your time axis and this is your payout, right? As in, so at each point in time, this is how much money you're getting paid out. So if you remember, we said that, so our bond, right? Our bond basically is a commitment to pay C It's the amount C every period, okay, on an outstanding balance of M, right? So the investor has basically borrowed M amount of money, and then a percentage of that, called the coupon, is being paid every month. So the cash flows, they look like this, right? So, excuse me, I've got a frog in my throat. So you get all these cash flows coming like this, right? Every period you get the coupon payment, and it's supposed to be exactly the same, right? So you get the same coupon period, and then at the end, where t equals maturity, we're going to get two cash flows, right? We're going to get our M back, right? So the bond pays out M. We get all the money back, and we also get the final coupon payment along with it, right? So we do get the interest for the last period as well, right? So we get C, right? So in total, on the last period, you get C plus M, and all the other periods you just get C. Okay. Excuse me. So let's say we're some way through the the life cycle of this bond, and the remaining payments are as follows, right? So the question is, as a recipient of these payments at these time intervals from now until maturity, what is that worth in today's money? Because I am going to be paying somebody actual money today, right? And it's going to be deducted from my bank balance today to actually be entitled to these payments, right? So what we do is, the question is, how much is each of these individual cash flows worth by discounting them back to today, right? In exactly the same concept that we discussed earlier, right? In terms of saying, well, if I know elsewhere that I can get 10% interest, right, then £1,331 in 3 years' time is equivalent to me receiving £1,000 today, right? And it's exactly the same concept here. What we're saying is, first of all, based on an interest rate, which is basically your alternative to say, well, any money that I have today, I can invest it at this interest rate, right? So based on that, how much is each of these payments worth in that money, right? In today's money, right? So, and it's quite simple. You basically, so let's say for simplicity's sake that these coupons are once every year, right? So it's annual coupon payments. So let's take the first cash flow, right? The first cash flow is a payment of C after 1 year, right? So what's that worth in today's money if my alternative interest rate is R, right? So R is my let's make it I, just because we've been using I and I don't want to confuse people too much, right? So let's say, our alternative interest rate that we can invest any money that we get today is I, right? So I is our discount rate, right? So basically, how much is C worth after a year in today's money? Well, PV is future value divided by 1 plus I to the n. After 1 year, basically is 1 period, so it's to the power 1, right? So basically, we have PV of the first cash flow is C divided by 1 plus I. Then for the second payment, which happens after 2 years, right? This chap here, the PV of that cash flow, right, in today's money, we're using the same discount rate, right? The same rate that I can invest that money in for 2 years this time, right? So what do I have to invest today at that rate such that after 2 years I would have the same amount as C, right, in 2 years? And that would be C over 1 plus I to the power 2, right? So that's year 1, 2, 3, 4, 5, 6, 7, 8, 9. So there are 10 periods left until this bond matures. 10 years actually, right? So you can see where this is going. And basically, so we can say PV of the nth coupon is the future value divided by 1 plus I to the power n, right? And where the future value, let's make it more explicit, is C. Okay, so basically what we're doing for the coupon payments, all we're doing basically is adding these present values up together, right? So basically but we forgot one thing, right? Which is, let's just cover that quickly. So after 10 years, we have this payment here, right? So we have, let's just draw a box around this. So after 10 years, we have our principal back, right? So what's the present value of that principal payment that we're going to receive in 10 years? What amount of money do I have to invest today, right, at the interest rate I, to achieve M in 10 years? Because that's the amount that receiving that in 10 years is actually worth to me today, right? So after 10 years, the present value of the principal payment is equal to M over 1 plus I to the power n, and n is 10 in this case, right? So basically, the present value of all of these cash flows together is actually what this bond is worth me buying, right? And I'll explain exactly why that is in a second. But effectively, so your price, your actual bond price, right, the actual money in dollar terms that you would be prepared to hand over to a dealer, sell-side dealer, to buy a Rolls-Royce bond or a Yarra bond or whatever, is quite simply the following, right? Coupon payment divided by 1 plus I, plus coupon payment divided by 1 plus I squared, plus coupon payment divided by 1 plus I cubed, all the way up to coupon payment over 1 plus I to the n, plus the principal payment, m over 1 plus I to the n, right? Where n is the number of remaining periods until maturity. Okay. Now this is basically a very simple geometric progression, right? So this bit here simplifies down in general terms for any value of n to the following. You can see I'm cheating because it's over here, but the general formula is basically C with the coupon payment multiplied by 1 minus 1 over 1 plus I to the n divided by I plus m over 1 plus I to the n. And it's as simple as that. That is the formula for a bond price where the bond basically pays fixed coupons, right? Equal regular coupons every year in this case, right? And where the outstanding balance is m. Now in real life, C is a percentage of m, right? So C and m are closely linked in the sense that C is a percentage of m, right? So if your coupon rate that you're getting, that the bond is paying in the offering circular is basically is, let's say, 10%, right? So that's your coupon rate. Then your actual coupon payment, this is a dollar amount, right? This is not a percentage. Just like this is a dollar amount as well, right? So if your interest rate is 10%, then your coupon rate is going to be m times r, right? So basically, in this case, it's going to be M times 1/10, right? So that's going to be your regular coupon payment, right? And that formula is basically, that is how you calculate what the price of a bond should be. So let's kind of put that into perspective with and just sort of give an example, right? So what it really means is that let's say that there's a bond, right, and that's being sold, right, and one of these dealers, let's say Goldman Sachs, calls me up and says, hey, I've got this bond, and I'm willing to sell it to you at this price, right? So let's put some numbers to it. So basically, what we're saying is, so let's say M is 1,000. Obviously, these numbers are ridiculously small compared to what you have in real life, but M is 1,000. Let's say C is let's say, so R we said was 10%. So the bond is paying a coupon, an annual coupon of 10%. So C therefore is going to be £100, right? The coupon is £100 per year, and let's say there are 10 years remaining. Okay, that's really all you need to know to plug in this to basically work out the formula. So the question is, right, let's say the dealer calls up, right, and he says, I'll sell you this bond, right, for, and I'm quoting you, £870, right? That's my offer, right? Do you want to buy it or not for this offer, right? Now, the basic principle here is that the price, okay, the price and the discount rate that you use to discount the cash flows are basically intimately related. So the only variables in this equation are the price and the interest rate, I, right? Everything else is fixed. C is £100, M is £1,000, N is 10 years. So you can't play around with those. But if the dealer says, I am going to offer you this bond, right? So basically, it's the entitlement to receive £100 per year for 10 years on this bond, and also the final payment of £1,000 after 10 years to get all the money back. I'm offering you all of that for the bargain price of £870. So at that point, do you go for it or not, right? What drives whether you actually want to buy the bond at that price? And the question is, it's all about this number I, right? Because what he's actually saying is, if you pay £870 for this here, right, and C is 100, and N is 10, and M is 1,000. If you solve this equation and find out what I is, then you're basically asking, what is I? What is the discount factor implied by paying £870 for this bond, right? And the question is that discount factor higher or lower than my alternative available interest rate, like my other best available interest rate, right? And that really, in a nutshell, is the key question around bond pricing. Obviously, the point is that in the market, buyers and sellers and dealers are at liberty to trade at whatever prices they want, right? It's not like the price of a bond is fixed and you know, I mean, it's up to the buyers and sellers to reach an agreement. But each buyer and each seller, each investor will have an idea of basically what this rate needs to be when rearranged from this equation in order for that price, in this case 870, to be attractive or not. Like maybe they'll go back and say, no, rearranging this equation here gives me a value of I that is too low, right? And therefore I'm not interested. If you lower the price down to, let's say, 800, and then rearrange the equation, then the value of I that it produces when you solve for I is basically a more attractive rate. And what I'm coming to saying here is that this value of I is a very, very important term in the world of bonds and bond valuations, and it is called the yield. And specifically, in this case, it's called the yield to maturity, right? Now, and that is going to be the subject of my next video. Okay, so I'm going to talk all about yield to maturity. So, in a nutshell, this was just a quick introduction to basically the fact that if we just go summarize what we've gone over, we've basically covered the fact that our bond has a stream of cash flows, right? That's what our cash flows are, and that we've introduced the concept of the time value of money and the fact that the promise to receive an amount of money in the future has to be valued in today's terms because we're buying the entitlement to receive that amount in the future, and the valuation in today's terms is purely dependent on what I can do with that money in terms of my available interest rate with basically a comparable risk of not getting my money back, and we talked about the stream of cash flows that a simple bond looks like, okay, and then we talked about and then we derived the ultimate price for a bond, right? And then we touched on this magic number I, and what that means in terms of how you arrive at bond prices, and then we said that basically in this equation I is actually referred to as the yield to maturity, and that is an extremely important field in this whole area. So I actually want to talk about one last thing. If you look down the bottom of the screen, because the example that we talked about here for this formula assumes basically that your periods are annual, right? Because I was your annualized discount rate. Now, what happens if you receive more than one payment in a year? So, for example, we saw in this example that we are making that our bond pays its coupon every year, right? Once a year, annually. But what if there are more than one? What if the bond pays, let's say, every 6 months? Well, it's quite simple. So if we just rewrite the formula again, right? So the bond price equals C times 1 minus 1 over 1 plus I to the n over I plus m over 1 plus I to the n, right? So that's the bond price. If there are more than one period in the year, right, then let's say there are f periods in the year. So let's say f equals 2. So our coupon pays every 6 months. Then it's quite simple, actually. You just basically literally divide everything up into those f payments, right? So it's your biannual coupon payment, right? In the case of semi-annual, is going to be the coupon divided by, so C is the annual coupon, right? In our example, it was £100. We divide that by f, so that's going to be the amount of money that you get every 6 months, right? 6 monthly payout, and then multiplied by 1 minus 1 over 1 plus I over f to the power n times f divided by I over f plus m over 1 plus I over f to the power n f. So if we just compare this one with this one, all we're saying is that each coupon, we've basically scaled everything down to semi-annual basis. So each coupon payment is being divided by 2, right? F equals 2 because we're doing semi-annual coupon payments. So our actual payout has gone from C to C over F, okay? And then over here, our interest rates have been scaled down by F as well, because this time we're actually getting our cash flows every 6 months instead of every 1 year, right? Now, if my alternative interest rate I, right, was in my alternative interest rate, the discount factor basically, if I can get 6% a year in an alternative bank account, but in 6 months I'm only getting 3%, right? So I'm compounding by, instead of n number of years, I'm compounding by n times 2 number of periods, right? So you're basically, everything is scaling, the periods over which you're compounding are being scaled down to a half of what they were, when f equals 2, right? So in 6 months I'm getting 3%, and then but the number of periods is now 2n, right? Where n is the number of years. So in our example where n equals 10, right? 10 years remaining on the bond, NF equals 20. What that means is there are 20 periods, right? There are 20 cash flows coming out. So if we go down here, the cash flow diagram looks a bit different now. It's basically 1, 2, 3, 4, 5, 6, 7, 8. I'm not going to draw 20 lines. 20 payments instead of 10, right? And then after 10 years, you get your M, and then you get your last C over 2, right? And each of these payments is C over 2 this time. C over 2, 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 C over 2. Okay? So the payments have been scaled down by C divided by F, or C divided by 2, right? So the payments themselves have been scaled down, but so is the time between payments, right? So if we go back to thinking about the how much is the first coupon payment worth? So guys, I'm sorry this is going on a bit. If it's clear, then I guess you can stop watching and go on to the next video about yield to maturity. But I just want to hammer it home that the first cash flow, which is basically C over 2, let's call it C over F to keep it general, the present value of that is C divided by F divided by 1 plus I over F, right? Where F is equal to, and I is my 6%, right, which is my alternative bank account that I can put that money in. But after 6 months, I'm only earning 3% on that, right? So, and then the second cash flow, PV of the second cash flow, is the present value of, again, another payment of C over F, or C over 2, divided by 1 plus I over F times 1 plus I over F, right? So basically, you can see how it's panning out exactly the same way. After 6 months, I've earned 3% in my alternative savings account. Therefore, but after 12 months, I've earned 1 plus I over F times 1 plus I over F, right? So you basically just brought everything down from annual basis to 6 month basis. So In the next video, I'm going to talk about yield to maturity. I'm going to go into some more detail about that and just carry on with these concepts. So I'm sorry if this video was a bit long-winded, but just wanted to sort of really hammer home the basics around time value of money, present value, bond cash flows, discounting the cash flows back to the present to determine what that bond is actually worth to you today, right? So thank you for watching. If you've got any questions, then please feel free to leave them below, and I'll see you in the next video. Bye.